Financial market observers are drawing attention to a convergence of geopolitical and commodity market developments heading into the Asian trading session scheduled to open at 6 o'clock Eastern Time on Sunday evening. Curious. At the center of this report is the COMEX silver futures market, which concluded its Friday trading session with silver locked at a closing price of $83.68 per ounce at 4:45 in the afternoon Eastern Time. Pause. That price has remained static through the weekend, as Western futures exchanges including the COMEX and the New York Mercantile Exchange are closed for the Saturday and Sunday trading pause. The report draws a distinction between the Western paper futures market, where trading is currently suspended, and the Eastern physical delivery markets, which are scheduled to resume operations Sunday evening. Specifically, the report identifies the Shanghai Gold Exchange, Hong Kong futures desks, and Singapore vaults as the first major market centers to reopen following the weekend pause. The report characterizes the Shanghai Gold Exchange as a physical delivery market, noting that contracts traded on that exchange are backed by physical metal held in auditable vaults, and that contract holders are entitled to take physical delivery of the underlying metal. The report contrasts this structure with the COMEX futures market in New York, where the report states that paper contracts can be sold representing quantities of silver significantly exceeding the physical metal actually held in registered vaults. The report states that on the COMEX, short selling of metal not physically held is permitted within the rules of the exchange, and that synthetic supply can be created through paper contract issuance. The report further notes that this system functions without disruption as long as contract holders do not demand physical delivery of the underlying metal. Central to the report's analysis is the figure of $214 billion, described as China's current trade surplus representing net export earnings accumulated over a recent period. The report identifies this surplus as a source of capital that Chinese institutions may deploy into physical commodity markets when Asian trading resumes Sunday evening. As we continue, a closer examination of the specific geopolitical developments that unfolded over this past weekend and how the report connects those events to the anticipated market activity at Sunday's Asian Open will be examined in full. To fully understand the context surrounding Sunday evening's anticipated Asian market opening, the report outlines in specific detail the geopolitical developments that took place over the 48-hour period spanning the weekend. The report identifies two primary developments as particularly significant in shaping the conditions heading into the Sunday night trading session. The first development concerns United States energy policy. The report states that the United States government, during the course of this weekend, sought to purchase sanctioned Russian crude oil. The report provides background context for this development, noting that the United States government had spent approximately 3 years prior to this weekend implementing a series of measures targeting Russia, including disconnecting Russia from the SWIFT international payment system, freezing an estimated $300 billion in Russian sovereign reserves, and issuing public warnings of secondary sanctions against any party purchasing Russian energy. The report states that the current stated rationale for the emergency oil purchase is concern over gasoline prices heading into the summer driving season, combined with what the report describes as a functionally depleted United States Strategic Petroleum Reserve. The report characterizes this development as a significant signal to Eastern market participants, specifically identifying Beijing and Shanghai as capitals where this development was being observed and assessed. The report states that the Chinese Communist Party Politburo monitored the United States government's actions over this weekend, and that the implications of those actions in the report's framing indicate a shift in the United States' position within the global energy market. The second major geopolitical development cited in the report concerns the Middle East. The report states that the regional situation has expanded over the same 48-hour weekend window, with the report specifically referencing Russian intelligence involvement in support of Iran. The report describes this as creating what it characterizes as a scenario in which a single miscalculated military action could result in the closure of the Strait of Hormuz, a waterway through which the report states approximately 20% of global oil supply passes. The report does not specify a timeline for this scenario, but presents it as an active risk factor being calculated by Eastern market participants heading into Sunday evening's trading session. The report then connects these two geopolitical developments directly to the anticipated behavior of Chinese institutional market participants when the Shanghai Gold Exchange opens Sunday evening. It states that Chinese institutions have assessed both the United States energy situation and the Middle East escalation and have incorporated those assessments into their commodity market positioning. The report frames Sunday evening's Asian market open as the first available opportunity for those assessments to be expressed through actual market transactions following the conclusion of the Western weekend trading pause. The report also references a historical precedent to support its description of the mechanism it expects to activate Sunday evening. It cites January of 2023 as a prior instance in which the Shanghai physical silver premium rose to 8% and states that during that period, registered silver inventories on the COMEX declined by 12 million ounces over a period of 3 weeks. The report attributes this inventory decline to arbitrage activity by Eastern market participants who exploited the price differential between the Shanghai physical market and the COMEX paper market. It states that the COMEX responded to that physical outflow by allowing the paper price to rise to $74 per ounce to stem the movement of physical metal out of Western vaults. Additionally, the report provides data on the trajectory of the Shanghai Gold Exchange physical silver premium over recent months. It states that the premium stood at 1.8% in December, rose to 2.4% in January, advanced further to 3.1% in February, and as of Friday's market close was recorded at 4.2%. The report presents this as a sustained directional trend rather than isolated short-term fluctuation, and states that a further rise in this premium to 6 or 7% would represent the threshold at which the report expects significant arbitrage activity to be executed by Eastern institutional participants. The report turns its attention in considerable detail to the specific market mechanics it describes as likely to unfold during the Sunday evening Asian trading session, beginning at 6 o'clock Eastern Time. The report identifies the electronic Globex silver futures market as the first venue where price movement would become visible to market participants monitoring the open in real time, noting that this market can be tracked through publicly available futures platforms and live silver price charting services. The report states that within the first 5 minutes of the Asian Open, significant price volatility is anticipated if Chinese institutional buying pressure materializes at the scale the report describes. The report outlines the specific arbitrage mechanism it expects Eastern institutional participants to execute. It states that Chinese institutions would simultaneously purchase silver at the COMEX paper price of $83.68 through the electronic Globex market while demanding physical delivery through the Shanghai Gold Exchange, thereby forcing physical metal to be transferred eastward. The report characterizes this as the same fundamental mechanism that produced the 12 million ounce COMEX inventory decline observed during January of 2023. While noting that the current geopolitical incentive structure is, in the report's assessment, significantly more pronounced than it was at that time. The report then describes in specific terms the risk scenario facing COMEX short position holders in the event that this arbitrage activity produces a sudden and significant price gap during the Sunday evening session. It presents a detailed hypothetical illustrating the vulnerability of leveraged short positions during low liquidity trading periods. The report states that a hedge fund holding a short position entered at $83, operating at 20-to-1 leverage across 10,000 contracts representing 50 million ounces of notional silver exposure, with $250 million in posted margin and a stop-loss order set at $86, would face a fundamentally different outcome during a Sunday night gap event than during a standard New York trading session. The report explains this distinction by reference to what it describes as a liquidity vacuum. It states that during the Sunday night trading session, there are no market participants providing bids at intermediate price levels between the Friday closing price and whatever level Eastern buying pressure drives the market to in the opening minutes of Asian trading. The report states that in this environment, a stop-loss order set at $86 would not be executed at $86 because no transactions occur at that price level during the gap. Instead, the report states the first available execution price would be wherever the market has already moved to by the time a matching order exists, which in the scenario the report describes could be 88, 91, or higher. The report states that in the specific hypothetical it presents, a gap from $83 to $91 in a 10-second period would convert an anticipated $15 million loss into a $35 million loss, triggering a margin call from the prime broker, requiring an additional $50 million in capital by Monday morning. The report contrasts this scenario directly with the position of a holder of physical silver, stating that physical metal holders carry no leverage, face no margin calls, have no stop-loss orders, subject to gap execution risk, and have no liquidation thresholds. The report states that in a gap-up event of the kind it describes, the only effect experienced by a physical silver holder would be an increase in the dollar value of their holdings without any required action on their part. The report also addresses the behavior of algorithmic trading systems operated by Western hedge funds during the Sunday evening session. It states that these systems are calibrated for the liquidity patterns and order flow characteristics of the standard New York trading session between 9:30 in the morning and 4:15 in the afternoon Eastern Time, Monday through Friday. The report states that these systems are not designed to process or respond to physical arbitrage pressure originating from the Shanghai Gold Exchange during the Sunday evening low liquidity window, and that the personnel with authority to make real-time risk management decisions are not actively monitoring positions during this period. The report further outlines 3 potential outcomes it identifies for the COMEX paper market in the event that large-scale physical delivery demands are executed through the Shanghai Exchange. The first is that bullion banks holding short positions cover those positions by repurchasing contracts at prevailing market prices, which the report states would produce a significant upward price movement. The second is that the exchange experiences what the report describes as a force majeure declaration, in which trading is formally suspended due to volatility exceeding circuit breaker thresholds. The third outcome referenced in the report is a scenario in which COMEX registered silver inventory, which the report states fell below 30 million ounces as of February 2026. Declines further as physical metal is removed from Western vaults through arbitrage-driven delivery demands. The report also draws a comparison to a prior historical event, specifically referencing March of 2020, when gold was trading at approximately $1,600 per ounce at the Friday COMEX, close before gapping up to approximately $1,700 within 10 minutes of the Sunday evening Asian market open, representing a $100 move in a 10-minute period. The report attributes this move to Eastern buyers anticipating Federal Reserve monetary expansion and purchasing physical gold before Western markets reopened on Monday morning. As Sunday evening's Asian market opening approaches, the report concludes by identifying the specific data points it characterizes as the most meaningful indicators for market participants monitoring the 6 o'clock Eastern Time open. The report states that the first and most immediate signal to observe is the behavior of the electronic Globex silver futures market in the opening minutes of the session. It states that price movement during the first 60 seconds of the Asian Open would provide an initial indication of whether large-scale institutional buying pressure is materializing. The report specifies that a gap upward rather than a gradual incremental price increase, would be the characteristic signature of the arbitrage-driven buying scenario it has described throughout this report. The report identifies the Shanghai Gold Exchange physical silver premium as the second key indicator. It states that the premium, recorded at 4.2% as of Friday's market close, would need to be monitored for movement toward the 6 to 7% range during the opening period of Sunday evening trading. The report states that a premium spike of that magnitude within the first hour of the Asian session would represent confirmation that Eastern institutional participants are aggressively executing physical metal purchases rather than engaging in paper futures activity. The report further states that if the premium reaches that threshold, it would, in its assessment, indicate that the price gap on the Globex electronic market is likely to be sustained rather than reversed when New York traders come online Monday morning. The report identifies a third confirmatory indicator to be monitored on Tuesday morning following the Sunday evening open. It states that COMEX registered silver inventory data published on a daily basis by the exchange would reflect any physical metal outflows resulting from Sunday evening delivery demands. The report states that a decline of 2 million or more ounces in registered COMEX silver inventory reported on Tuesday morning would serve as confirmation that arbitrage-driven physical drainage of Western vaults had occurred during the Sunday night session. The report presents these three data points: the Globex opening price action, the Shanghai premium movement, and the subsequent COMEX inventory report, as a sequential framework for assessing whether the market developments it has described have materialized as anticipated. The report then returns to the broader structural argument that frames its entire analysis. It states that the COMEX silver futures market currently carries a leverage ratio of 28 paper claims for every single physical ounce of registered silver inventory, based on its figures of 170,000 open interest contracts at 5,000 ounces each against 30 million ounces of registered physical inventory. The report presents this structural characteristic as an inherent and ongoing vulnerability in the Western paper pricing system, independent of any specific weekend's geopolitical developments. It states that this vulnerability becomes most acute during periods of elevated physical demand from Eastern markets, particularly when combined with the kind of geopolitical catalyst the report has identified in the current weekend's developments. The report also addresses the longer-term industrial demand picture for silver, reiterating figures it presented earlier in its analysis. It states that global silver mine output of approximately 850 million ounces per year is projected to fall short of industrial demand, anticipated to exceed 1.2 billion ounces annually by 2028, producing a projected annual supply deficit of 350 million ounces. It identifies high-efficiency photovoltaic solar cells, artificial intelligence server thermal management systems, and 5th-generation wireless antenna arrays as the primary industrial applications driving this demand trajectory, and states that no currently available substitute material exists for silver in these specific applications. The report presents the Shanghai Gold Exchange physical premium trend data one final time in its closing analysis, restating that the premium moved from 1.8% in December to 2.4% in January, 3.1% in February, and 4.2% as of Friday's close, characterizing this as a systematic and directional trend reflecting sustained Eastern market willingness to pay above the COMEX paper price to secure physical metal. The report states that this trend, in combination with the geopolitical developments of the current weekend, constitutes the backdrop against which Sunday evening's Asian market open will take place. The report closes by reiterating the two scenarios it presents as the potential outcomes for COMEX bullion banks in the event that Sunday evening's physical buying pressure reaches the scale it has described. It states that bullion banks would face a choice between covering short positions at significantly higher prices, thereby producing a substantial upward price movement, or declaring an inability to deliver physical metal against outstanding contracts. The report states that either outcome would result in the COMEX closing price of $83.68 per ounce, becoming an inaccurate reflection of physical silver market conditions by the time Western markets reopen on Monday morning. That concludes our full coverage of this developing financial and commodity market report. The Asian trading session is scheduled to open at 6 o'clock Eastern Time Sunday evening. Registered COMEX silver inventory data will be published Tuesday morning. The Shanghai Gold Exchange physical premium will be observable in real time through the opening of the Sunday session. We will continue to monitor all relevant data points and bring you updated coverage as market conditions develop. This has been your financial market briefing. Stay informed, stay verified, and we will see you in the next report.